This week we're reviewing the Foord Equity Fund. Cobie, over to you. A size, 1.2 billion rand is the size, incepted in 2002.
Yeah, let me tell you a little bit about this business. This business was started by a gentleman called Dave Foord. It actually got started in conjunction with another gentleman by the name of Liston Maintjes, who subsequently has moved out of the business. A long-standing asset management business and kind of those private partnership type businesses, formed in 1981 by Dave Foord, and it's probably close to, a 30-year track record now as far as his asset management business is concerned. It's a nice, concentrated, deep value fund manager that's kind of run and kind of owner managed and where the owner is kind of very, very involved. Before that, Dave obviously was an investment analyst and in various financial roles. Let me just tell you quickly about the fund. The manager here is Dave Foord. He co-manages with Dane Shawan and Nicholas Belkin. September 2002 is the formation date, and a nice size fund at 1.2 billion. Big TER though for this fund at 2%. Let's just look at performance numbers quickly. Last 12 months, 7.4 versus 3.6, the benchmark there being the all-share index. Last 3 years, 13.5 versus 10.6, and last 5 years, 10.7 versus 8.8. Very, very nice outperformance. Let's just quickly look at the graphic that you've got on your screen there at the moment. It shows again the rolling 12-month return for the all-share index that you see on the as far as the red line is concerned over there. And then the blue areas that you see, which is that over there, and all the rest of them, those indicate the relative return. So when it's above the line, such as it is over there, it's outperformed. And let you read over the axis on this side over here, the magnitude of the outperformance. And when it's below the line, it actually shows underperformance. So some underperformance, obviously, in 2008 that you can see over there. You see some underperformance as far as this fund is concerned, but then subsequent to that, actually great outperformance for this fund.
And it's interesting because recently, most of the funds that we look at, very seldom do we actually see outperformance over the last couple of years. It seems that most funds have been underperforming.
And there's a portion in cash here. This fund currently has got about 8% in cash. So generating outperformance, well, obviously the markets come down and cash helps you in that regard, but definitely some skill.
Heavily weighted within the industrial sector, does that worry you?
I think we've got a chart on the asset allocation. It is diversified within industrials, but it has a very high exposure to industrials at 60%. So it's a very focused fund. But what I found interesting about the analysis that we did on this is that although it's a high exposure to industrials, the weighting does not reflect the sensitivity of industrials. So to explain that differently, when industrials go up, the fund doesn't go up as much as the industrial. So it's a conservative exposure to industrials with a low beta weighting there. And across the board, financials, industrials, and resource exposures here, this manager is choosing defensive stocks within those sectors. And that, to a large extent, has generated that outperformance.
Yeah, fantastic outperformance. Many of the funds that we've looked at on the show have battled relative to their benchmarks. And you just see here complete conviction. And I have to say that the
all-share index essentially is the benchmark.
Yeah,
so
it's a tough benchmark.
Yeah.
It's not like it's an easy benchmark.
And it's a resource-heavy benchmark.
Sure, absolutely.
So.
Look, it comes with a caveat though, and the caveat is that there are times that this fund could underperform. And and when it does happen, it happens for good reason. And when you speak to people that manage these kind of funds, they'll say to you, stick in there because there's going to come a time when there's going to be great outperformance again. But the immediate track record here has been fantastic. The long-term track record is in place.
You'll find in strong bull markets, a fund like this, which is defensive, won't do as well as the market. So those are the risks that you're taking. If we're going to start shooting the lights out, the all-share index, this fund won't necessarily keep up if the fund manager doesn't adapt.
Value fund, kind of classic value fund and classic kind of value thinking. And again, this kind of works in kind of very nicely with what we spoke about with stock market crashes. It's going to happen. Just be patient. Sit on cash, be patient, and when it does happen, buy those companies that you really want exposure to rather than just buying absolutely everything.
And of course, also having a bit of a weighting in financials, slightly lower than what we see in the overall JSE. Are you concerned about that? Do you want to see a bit more of a reweighting occurring? We know that resources stocks are offering slightly more value right now relative to industrials.
I think both financials and resources probably are a cheaper option. We're obviously looking at, in hindsight, at what the weightings are, so the fund manager might be adapting the fund as we speak. But I would be worried if 60% of my money is sitting in industrials, and if we're expecting this kind of lower for longer kind of environment with slow economic growth, and industrials do not shoot the lights out, this fund can heavily underperform.
What would shoot the lights out in an environment lower for longer?
Well, I think anything that is defensive in nature will do well. So this fund on aggregate is defensive, but it's very heavily weighted towards industrials. So I like the defensive nature, but I'd like to see it across the board, picking up stocks that have a low beta to the market.
Yeah, I mean, it's tough. I mean, I think that, you know, when guys bought the stock into this portfolio, they did it because, you know, the valuations were just so much more attractive within industrials. To do it right across the board sometimes is quite difficult because there's sometimes just not the kind of stock that you want to buy in certain other areas. So the question is, what do? Do you play more of kind of a balanced game, or do you then wait and then say, if you speak to the guys who manage this fund, they'll say to you, listen, we try and buy the best we can at the best prices. That's what we try and do.
So let's unpack this now. We've got a closing comments. We need to see your closing comments. Cobie, it's really tough out there right now. Quite a bit of volatility. JSE in negative territory for the year to date. Are you buying equities at this point?
You should be.
No, I'm not asking if you should be. I'm asking if you are.
Well, I mean,
have you been accumulating stocks, and if so, which?
Well, let's talk about global stocks. Let's talk about globally. Firstly, yes, internationally, absolutely.
Okay.
Especially when the rand was a little bit stronger than where it is now. You know, at a 12 PE, maybe you want to kind of hang about, you know, back a little bit, but you know, there's going to come a time where you want to start buying again. Yes, absolutely.
Roland, good time to buy or stay away for now?
I actually measure sentiment, and it is still very negative at the moment. So I am definitely underweight equities and overweight a cash kind of exposure. But if you want equities, I definitely think you've got to still stay with the defensive, high-yielding kind of dividend-yielding, income-based stocks.
Fantastic, gentlemen. We have to leave it there. Thank you so very much for joining me.